They told you China holds over $1 trillion in American Treasury bonds and that this makes them dependent on American success. That dumping those bonds would hurt China as much as America. That mutual financial destruction prevents economic warfare between superpowers. But what if every assumption you've been fed is backwards? What if China has been systematically reducing their treasury holdings for over a decade while hiding the true scale and coordination of the sell-off? And what if the $800 billion they've already dumped is just the beginning of a financial attack so sophisticated that by the time American officials acknowledge it's happening, the damage will already be irreversible and the dollar's status as the world's reserve currency will be in terminal decline? The official numbers from the United States. Treasury Department showed that China's holdings of American government debt peaked in 2013 at approximately $1.3 trillion, making them the largest foreign holder of treasuries and effectively the biggest creditor to the United States government. By 2023, those official holdings had fallen to around $850 billion, a reduction of roughly $450 billion over 10 years, which sounds significant until you realize that the real number is likely far larger because China has developed sophisticated methods to hide their treasury sales through third-party nations and offshore accounts that don't show up in the official data. Belgium, a small European country with an economy a fraction of the size of China's, somehow holds over $300 billion in American treasuries. And financial analysts have long suspected that a significant portion of those holdings are actually Chinese assets being managed through Belgian custody accounts to obscure the true scale of China's divestment from American debt. The Cayman Islands and other Caribbean financial centers show similar patterns with treasury holdings that are disproportionate to the size of their economies and that fluctuate in ways that correlate suspiciously with Chinese economic policy changes and geopolitical tensions with the United States. When you add these suspected hidden holdings to the official numbers and then calculate the total reduction, the real figure of Chinese treasury dumping over the past decade likely exceeds $800 billion. And may be approaching $1 trillion, representing one of the largest coordinated sales of a single asset class by a foreign government in the history of global finance. But the scale of the selling is only part of the story, because what matters more than the amount is the acceleration. The fact that China's treasury sales have been increasing in pace and coordination with other nations, creating a pattern that looks less like normal portfolio rebalancing and more like the execution of a long-term strategic plan to undermine dollar dominance while positioning China for the post-dollar world. The question nobody in Washington wants to ask publicly is what China is doing with the proceeds from these treasury sales. Because the answer reveals the true nature of the strategy and exposes just how vulnerable the dollar system has become. China isn't selling treasuries to hold cash or to invest in other currencies. They're converting American debt into physical assets that will retain value when paper currencies collapse, specifically gold, commodities, strategic resources, and infrastructure projects across the developing world through the Belt and Road Initiative. Every treasury bond China sells is effectively them saying, we no longer believe in the long-term value of dollar-denominated assets. We no longer trust that America can service its debt without inflating the currency. And we are converting your paper promises into real wealth before the system breaks down entirely. The gold accumulation is particularly telling because China has been the world's largest gold buyer for over a decade, both through official central bank purchases and through imports that flow into private hands, but ultimately serve state interests. The People's Bank of China officially reported holding approximately 2,000 tons of gold as of 2023. But analysts at the World Gold Council and independent researchers estimate the real figure could be anywhere from 4,000 to 30,000 tons. When you account for off-balance sheet holdings, undisclosed military reserves, and gold held by state-owned enterprises that doesn't appear in central bank reports. If the higher estimates are correct, China may already hold more gold than the United States officially claims to have in Fort Knox, and they acquired much of it by selling the treasury bonds that America issued to finance its deficits and wars and endless government expansion. The mechanism of this exchange is elegant in its simplicity and devastating in its implications, because China produces real goods that America wants. Electronics and clothing and machinery and everything that fills American stores and homes. And America pays for these goods by printing dollars or issuing treasury bonds, pieces of paper that represent promises to pay in the future with interest. China could hold those bonds and collect the interest, but they recognize that a debtor who can print their own currency always has the option to pay, back in devalued money, to inflate away the debt rather than honor it in real terms. So instead, China takes some of those dollars in bonds and converts them into gold, into commodities, into real assets that can't be printed or devalued by Federal Reserve policy. And in doing so, they're essentially saying, we will accept your paper in exchange for our goods, but we will not hold your paper as wealth. We will immediately trade it for something real before you destroy its value through inflation. This strategy becomes even more powerful when you understand that China isn't acting alone, that they've been coordinating with other nations through the BRICS alliance and bilateral agreements to create a synchronized reduction in global treasury demand that will ultimately force interest rates higher and make America's debt unsustainable. Russia dramatically reduced its treasury holdings starting in 2020, selling off over $100 billion worth and cutting its total holdings to less than $10 billion, effectively eliminating dollar reserves from its central bank in response to American sanctions and as preparation for the financial warfare that would intensify after the invasion of Ukraine. Other BRICS nations have followed similar patterns, with Brazil, India, and South Africa all reducing their treasury holdings or slowing their accumulation despite growing foreign exchange reserves, which means they're actively choosing to hold fewer dollars and fewer American bonds even as their overall wealth increases. If you're starting to feel that uncomfortable recognition that the financial system you've trusted your entire life is built on relationships that are dissolving and assumptions that are being tested to destruction, then you're beginning to understand what China has been building while America was distracted by partisan politics and culture wars, and the comfortable belief that dollar dominance is permanent and unchallengeable. Subscribe now, because what comes next reveals the timeline of the collapse and the specific triggers you need to watch that will signal when the coordinated treasury dump moves, from gradual decline to catastrophic acceleration. And understanding that timeline is the difference between protecting your wealth and watching it evaporate in a currency crisis that will make previous devaluations look like minor corrections. The year 2020 marked a crucial inflection point in this slow-motion financial war, because that was when the United States and its allies seized $300 billion in Russian central bank reserves, effectively stealing money that Russia had accumulated through decades of oil and gas exports and held in dollars and euros, with the assumption that reserve currencies were neutral stores of value rather than weapons that could be confiscated through executive order. That action sent shockwaves through every central bank and finance ministry on earth, because it demonstrated unequivocally that holding dollars isn't safe if you're not aligned with American foreign policy, that your reserves can be frozen or seized at any moment based on political decisions rather than legal proceedings, and that the entire system of dollar hegemony is built on American military and political power rather than genuine trust or contractual certainty. China was watching carefully and drawing conclusions, because if the United States could seize Russian reserves over the Ukraine invasion, what would stop them from seizing Chinese reserves over Taiwan or trade disputes or any of the dozens of friction points between the two nations? The answer is nothing. There's no legal or institutional barrier preventing the United States from freezing Chinese Treasury holdings if a crisis erupts, and that realization accelerated China's already existing plans to reduce dollar exposure and build alternative systems. The pace of Treasury sales increased in 2022 and 2023, with China's official holdings dropping by over $100 billion in just 2 years. But more importantly, the diversification of where they were putting the proceeds became more strategic and more focused on assets that America couldn't touch or control. Belt and Road infrastructure projects in countries that are either neutral in the U.S.-China competition or actively aligned with Beijing represent investments that generate returns in real economic activity, rather than financial paper, mines that produce copper and lithium and rare earth elements, ports that control choke points of global trade, energy infrastructure that makes countries dependent on Chinese financing and technology. These investments serve multiple purposes simultaneously. They deploy the proceeds from Treasury sales into assets that can't be frozen by American authorities. They build Chinese influence and economic dependence in developing nations. They secure access to the physical resources that will be needed for the next century of economic competition, and they create an alternative pole of global financial power that doesn't root through New York or Washington or the dollar system. The coordination between China and other nations in reducing Treasury holdings becomes even more apparent when you look at the timing of major sales relative to geopolitical events and American policy decisions, because there's a pattern that suggests communication and strategic planning rather than coincidental market movements. When the United States announced new tariffs on Chinese goods in 2018 and 2019, China responded by slowing their Treasury purchases and even selling small amounts, sending a message that trade warfare would have financial consequences. When tensions over Hong Kong intensified in 2019 and 2020, Treasury sales accelerated again. When American sanctions on Chinese technology companies like Huawei and semiconductor firms became more aggressive, the pattern repeated. Each time America used its economic leverage to pressure China. China responded by quietly reducing its exposure to the dollar system and moving assets into alternative forms. And this tit-for-tat pattern suggests that Treasury holdings are being explicitly used as a lever in the broader geopolitical competition, not as an immediate weapon that gets deployed dramatically, but as a long-term strategic repositioning that weakens American financial power gradually until the system reaches a tipping point where the decline becomes self-reinforcing and unstoppable. The mathematics of debt dynamics means that China doesn't need to dump all their treasuries at once to cause a crisis. They just need to sell enough to push interest rates higher than the American economy can sustain. And given the size of U.S. government debt, that threshold is much lower than most people realize. Total federal debt is now approximately $34 trillion, which means that every 1% increase in the average interest rate costs the government an additional $340 billion per year in debt service. When interest rates were near zero during the decade after the 2008 crisis, the government could afford to run trillion-dollar deficits without the interest payments becoming unmanageable. But as rates have risen to fight inflation, debt service costs have exploded, and the Congressional Budget Office projects that by 2030, interest payments on the national debt will exceed defense spending and become one of the largest items in the federal budget. This creates a trap that China can exploit without even trying. Because as the Federal Reserve raises rates to fight inflation, or as Treasury buyers demand higher yields to compensate for the risk of holding depreciating dollars, the cost of servicing the debt rises automatically and forces the government to choose between cutting spending, which triggers recession and political upheaval, raising taxes, which also suppresses economic growth and is politically toxic, or printing more money to cover the deficit, which causes more inflation and requires even higher interest rates and creates a death spiral. China can accelerate this process simply by being one less buyer of treasuries, by forcing the remaining buyers to absorb more debt and therefore demand higher yield, and by demonstrating through their actions that the smart money is moving away from dollar assets toward alternatives. The broader pattern that should terrify anyone paying attention is that China isn't just selling treasuries and buying gold. They're building the entire infrastructure for a post-dollar world. From the SIPS payment system that bypasses SWIFT to the digital yuan that offers an alternative to dollar-based banking to the petroleum agreements that allow oil to be purchased without dollars to the commodity. Exchanges being developed in Shanghai that will price metals and agricultural products in yuan rather than dollars. Each of these initiatives individually might seem like a minor challenge to dollar dominance, but together they represent a comprehensive alternative system that will be ready to absorb global trade when the dollar system fails or when China decides the moment is right to accelerate that failure. Would you continue holding an asset that you knew was losing value and could be confiscated at any moment by a foreign government? Or would you diversify into alternatives that preserve wealth and can't be frozen by executive order? Because that's the calculation every central bank and sovereign wealth fund and large international investor is making right now. And the answer increasingly is to reduce dollar exposure, not eliminate it overnight, but gradually, steadily, until dollar dominance is no longer a reality, but a memory of how the system used to work before the world became multipolar. The selling pressure on treasuries doesn't just come from China. It comes from the mathematical reality that America is running deficits of nearly $2 trillion per year, which means the Treasury Department needs to find buyers for $2 trillion in new bonds annually just to fund current operations before accounting for the trillions in existing debt that mature and need to be rolled over. In a world where China was buying hundreds of billions per year and other foreign central banks were also accumulating reserves. This was manageable because there was steady demand. But as foreign buyers step back or actively sell, the Federal Reserve becomes the buyer of last resort, which means printing money to buy a government debt, which is just monetization of the deficit by another name, and which causes inflation that destroys the purchasing power of the dollar and makes foreigners even less willing to hold treasuries in a self-reinforcing cycle. The domestic consequences of this dynamic are already becoming visible in inflation rates that remain elevated despite Federal Reserve claims to have it under control. In the fact that real wages adjusted for inflation have declined for most Americans over the past few years. In the reality that the cost of food and housing and energy has increased far faster than official statistics suggest. These aren't random economic fluctuations. They're the direct result of decades of deficit spending and money. printing coming home to roost as foreign buyers who previously absorbed the inflation by holding depreciating dollars decide they're no longer willing to subsidize American consumption and instead dump the bonds back into the domestic market where Americans have to deal with the consequences of their government's fiscal. China understands this dynamic perfectly because they studied how previous reserve currencies lost their status, how the British pound went from dominant to secondary over the course of a few decades in the 20th century as Britain's debts from 2 world wars and the costs of maintaining an empire became unsustainable, and as the United States emerged as a creditor nation with a more stable currency, the transition wasn't instantaneous. It happened gradually as trade patterns shifted, as countries diversified their reserves, as alternatives became available and then preferable, until one day the pound was no longer essential and Britain had to face the reality of being an ordinary country with ordinary constraints rather than an empire that could print money and have the world accept it. America is now in the British position from a century ago, running deficits to fund military commitments around the world, facing rising competitors who have stronger fiscal positions and are building alternative systems, watching as the advantages of controlling the reserve currency turn into disadvantages, as that control requires ever more money, printing to maintain, and as the inflation from that printing destroys the currency's value proposition. China is positioning itself to be the creditor nation, the one with positive trade balances and massive reserves of real assets and a currency that may not be fully convertible yet but is increasingly accepted for trade settlement. And the parallels to the American rise and British decline are too obvious to ignore once you see the pattern. The timeline for when China's treasury dumping moves from strategic erosion to tactical attack is impossible to predict precisely because it depends on factors that are partly within Chinese control and partly dependent on American mistakes and global events. But there are certain triggers that would likely accelerate the process and force China to move more aggressively. A military conflict over Taiwan would almost certainly trigger massive treasury sales as China retaliated against American sanctions and tried to crash the dollar to make the war. Costs unbearable for the United States. A major financial crisis in America that required massive Federal Reserve intervention and money printing would likely convince China that the dollar's value was about to collapse and spur them to sell remaining holdings while they still had some worth. A political breakdown in the United States that called into question the government's ability to service its debt or that threatened default could trigger the same response. But China might not wait for any of these crises. They might simply decide that the alternative systems are sufficiently developed, that enough other countries are ready to join a dollar alternative, that American power is sufficiently weakened by internal divisions and external over, and that the moment is right to launch the BRICS currency or dramatically accelerate yuan internationalization or announce their pricing all exports in yuan rather than dollars. Any of these moves would represent a point of no return, where the dollar's dominance is openly challenged rather than quietly eroded, and once that challenge is public and successful, the network effects that made the dollar essential would reverse and make it optional, then undesirable, then ultimately worthless except domestically. If you're watching this and feeling the weight of realization that everything you thought was permanent is actually temporary and that the financial system you've built your life around is in the process of a collapse that will accelerate into something catastrophic, then you understand the position that millions of Americans are going to find themselves in when the treasury market breaks and interest rates spike, and the government has to choose between default or hyperinflation. Subscribe right now because the next episode reveals exactly how to position yourself ahead of this crisis, what assets to hold and what to avoid, how to protect wealth during currency transitions, and why the conventional wisdom about diversification and retirement planning is completely wrong for the environment. We're entering where the dollar loses reserve status and America becomes a normal debtor nation with all the constraints that implies. China's $800 billion treasury dump isn't a historical event that happened and concluded. It's an ongoing process that's accelerating under the surface while official spokespeople on both sides pretend it's not happening or minimize its significance. The sales continue every quarter, hidden in custody arrangements in third-party holdings, disguised as normal portfolio rebalancing, coordinated with other nations who are following similar strategies, and building toward a tipping point where the remaining treasury buyers are insufficient to absorb the new debt issuance. And the Federal Reserve has to step in as permanent financier of government deficits, which destroys any pretense of central bank independence and any hope of controlling inflation without triggering depression. The coordination with Russia is particularly important to understand because Russia has already gone through the full cycle of dependence on dollar reserves, followed by weaponization of those reserves, followed by complete abandonment of the dollar system. And they're now operating as a test case for how a major economy can survive and even thrive without access to dollars or integration with Western financial infrastructure. The fact that Russia hasn't collapsed, despite comprehensive sanctions, demonstrates to China and other nations considering reducing dollar dependence that alternatives exist and can work. That CIPS and yuan-denominated trade and commodity-backed currencies aren't just theoretical possibilities, but practical realities that can sustain major economies even in the face of American financial warfare. This demonstration effect is potentially more damaging to dollar hegemony than the direct selling pressure from China's treasury dumping, because it proves that the dollar system is optional rather than mandatory, that countries can opt out and survive, and that American threats to use financial access as a weapon are becoming less credible as alternatives develop. Every nation that successfully trades outside the dollar system makes it easier for the next nation to do so. Every transaction settled in yuan or through CIPs or in bilateral arrangements, the bypass SWIFT is proof that the network effect sustaining the dollar can be broken. And as more countries join the alternative system, the value proposition of staying in the dollar system declines until even America's closest allies start questioning whether maintaining exclusive dollar dependence is worth the risk. The psychological aspects of reserve currency decline are as important as the mathematical ones, because money is ultimately a collective belief system, a shared agreement that certain pieces of paper or digital entries have value because everyone else treats them as valuable. And when that belief starts to crack, the decline can happen with shocking speed, as each person or institution or nation rushing for the exit makes it more urgent for everyone else to leave as well. The dollar has benefited for 80 years from positive network effects where its dominance created more dominance. But those same network effects work in reverse once the tipping point is crossed, and China's strategy seems designed to find that tipping point to push just hard. Enough and steadily enough that the world gradually loses faith in dollar dominance, until suddenly the faith is gone entirely and the scramble to exit begins in earnest. The assets that China is accumulating with their treasury sale proceeds represent not just a store of value, but a vision of what post-dollar global finance will look like, where economic power flows from control of physical resources and productive capacity rather than from printing the reserve currency and forcing others to use it. Gold provides the backing for a commodity-based monetary system that can't be inflated at will by any single government. Strategic metals and minerals provide the inputs for technology and manufacturing that will define 21st century economic competition. Energy infrastructure provides the power needed to run modern economies. Agricultural resources provide food security that becomes more valuable as populations grow and climate changes, and all of these assets have the crucial characteristic that they exist in physical reality rather than as accounting entries that can be frozen or devalued by hostile governments. Would you rather own things that exist independently of any government's promises, or would you rather own promises from a government that's $34 trillion in debt and printing trillions more every year to cover deficits that keep growing? Because that's the choice China has made, and it's the choice that more and more nations and investors are making as they look at the trajectory of American fiscal policy and conclude that the emperor has no clothes. That dollar dominance isn't backed by economic strength or fiscal responsibility, but by military power and historical inertia. And both of those are eroding faster than official narratives admit. The endgame of China's treasury dumping strategy isn't to hold zero American bonds. It's to hold just enough that they can still participate in the dollar system when necessary, while having diversified sufficiently that a dollar collapse doesn't destroy their wealth, and to have built comprehensive alternatives that become the new default for global trade once the dollar system fails. They want to be positioned so that whether the dollar declines gradually or collapses suddenly, China benefits either way. Gradually, if it happens slowly through increasing trade in yuan and steady accumulation of physical wealth, or dramatically if it happens quickly by being the nation that everyone turns to as the new center of global finance because they have the gold, the resources, the infrastructure, and the alternative systems already built and operational. The tragedy for America is that this was all avoidable. That if the United States had maintained fiscal discipline and avoided weaponizing the dollar and refrained from running permanent deficits and resisted the temptation to print unlimited money to solve every problem, the dollar's reserve status could have been maintained for generations more. But those choices weren't made, and now the consequences are inevitable. Not in the timing, which remains uncertain, but in the direction which is clear to anyone willing to see it. And China's $800 billion treasury dump is both cause and symptom of a global financial system and transition from American unipolarity to something multipolar where the dollar is optional and China's yuan is ascendant and the entire architecture of global commerce is being rebuilt from the ground up. If this has transformed your understanding of what's actually happening in global finance beneath the surface of daily headlines and official reassurances, if you're seeing for the first time that the game is already over and the only question is how fast the remaining dominoes fall, then you need to see the next episode where we reveal the specific timeline, the exact indicators to watch, and most importantly, the actions you can take right now to protect yourself before the system breaks completely and your wealth evaporates along with the dollar's value. The treasury dump is accelerating, the alternatives are operational, and time is the only resource you can't recover once it's gone. So make your choice now while choice is still possible. Because soon the only option will be enduring the consequences of decisions that other people made while you were told everything was fine,